Hello, everybody, and welcome to this week's edition of Selfwealth Live, our technical analysis edition. We're here with Jason McIntosh from Motion Trader, and myself, Roger at Selfwealth. Jace, how are you this week?
Hey, Rog, I'm all pretty good at my end, and a few things going on in the market. So I think we've got a bit to talk about today. I think it should be an interesting technical session.
We do have a few things. Obviously, president was decided, so it's for now. It's good news for the markets. Everyone's telling me on the phones and things like that they're still pretty bullish. So and then we've also got a few questions come in throughout the week from viewers. Some people complimenting me also on my mustache, so which is great. It's great to hear the feedback around generally is it's a great show, and they're loving the Mo, right? So just as a general shout out, the reason why I've got the Mo at the moment is to support the Movember cause. So wherever you see the Movember cause supporting mental health, prevention of looking for prevention of cancers in men, then please do support the cause, right? So other than that, Jace, I'm keen to get going. We've already got a few questions coming in online as well as a few questions that we've had throughout the week. So it looks like we're going to have a big show today. Let's please start with a disclaimer. Let's get going.
Yeah, well, that's all terrific to hear, Rog. And so everything we do today is general commentary only, no personal advice. And let me just quickly put up our disclaimer. And that just goes through that. And of course, I'm not part of Selfwealth. I'm from Motion Trader. That is my business. And you'll see my details at the top, licensing, etc. And the same with Selfwealth just below that, all the licensing details. And again, general commentary only.
Thank you very much, Jason. Hello to everyone online once again. Thanks for coming and visiting us and sending us your questions. It's fantastic to be able to get these questions and be able to answer them. And we're going to have a look at some of your tickers that you're already sending through. But for now, let's start with the Aussie market. How have we reacted here in Australia to all the news overseas?
Right. Okay, there we go. We've got our local market up there on the screen. And it's really been a fascinating few days. So election last week, US markets have charged off new all-time highs. And then you come and you look at the Aussie market, the ASX 200, and it's still somewhat below its October high. So the question, I guess, that's raised from that is this failure to follow the US market some sort of a cause for concern? So I'll start with a question for the viewers. And of course, you don't need to answer this, but just thinking to yourself. So when you look at this chart, what do you see? What do you see when you look at this? What's changed from last week or last month for that matter, or for that matter, the month before that? What's different on this chart? And I think the answer to that is that despite all the uncertainty, the basic chart structure is essentially unchanged. And now, if you're a regular Selfwealth live viewer, or you come to my weekly strategy sessions on a Friday, you're going to pretty much know how this goes. But if you're new to chart analysis, I think this is a really important concept to take in. So step one for me is I look at the moving averages. I use a 50 and a 100-day moving average pairing. I'll look at those moving averages and I'll see what direction. I want to ask myself, what direction are these moving averages heading in? And then the second step is that I will look at where the price is relative to those moving averages. And at the moment, the price is above the moving averages. And of course, the moving averages are moving higher. So by definition for me, that's a bullish chart structure. And it has been all year. So you go all the way back to where we were this time last year, or a little bit further back to this time last year. It's been the same story. Price above rising moving averages, with of course a few dips beneath, but that's all acceptable within a rising trend. So for me, the default position is that we're still within a bullish market. The game plan throughout this period. And when I say this period, it's really been over the last 12 months. The game plan has really been about staying long equities. Of course, we need to manage risk. It's not just being blindly buy anything. Got to manage risk, of course, but generally just being focusing on owning stocks, and that hasn't changed over the last week with elections and uncertainty leading into them and coming out of them. That hasn't altered. And remember, though, I think an important thing to remember, though, is to just know that stocks, of course, they don't rise every week. They don't rise every month, for that matter. Just looking at this chart now, just trying to work out like where could things go from here. And we're kind of range bound at the moment. We've got the October high, we've got the November low, and we're somewhere in between at the moment. I think what we might see happen over the next several weeks is some sort of, I think we might see more consolidation. And one scenario would be, so we can actually just draw something up. Say one scenario might be the market, maybe we could see the market move sideways for several weeks. So if we sort of see some sideways price action, maybe as the moving averages move higher, so just maybe sideways along the moving averages, and then from there, perhaps we could then consider, like, could we see a break to higher levels in sometime later in the year, moving into next year. Of course, this isn't a roadmap to follow. It's just possible scenarios. That's one of the things I like to do. I like to think about what sort of price action have we seen in the past? What could it look like into the future? And this is sort of one way. And I think having ideas about where the market could move can also be really helpful just to have in mind. So you're not sort of like just looking at the news each night, the market's up, the market's down. What does all that mean? We're kind of looking at it looking at it on the basis of how the structure might look as we go forward, and that can help us manage our positions and expectations. But at this point, I think there's probably more consolidation to come. It could end up looking something like this period from back in June, where we had a high, the market came back, and then we had sideways, and that lasted several months. Of course, it's not going to look exactly like this. We look for variations of things that we've seen in the past, and that's what consolidations often look for. And then that could provide that platform we need to see the new all-time highs and see the higher levels. I think where things currently stand, I think it's a case of giving the incumbent trend, and the incumbent trend is a rising trend, giving that the benefit of the doubt, and don't be surprised if there is more chop, more consolidation in the coming weeks. As always, we need to manage risk, and I'll be doing that by using wide trailing stops, like giving the market plenty of room to move around, because I want to be able to try and stay with my best trades, and but I also want to have an exit plan should things deteriorate. But at this point, it's giving that incumbent trend the benefit of the doubt.
All right, fantastic. Can we have a quick look at the All Ordinaries as well? Is it a similar picture?
Yeah. Very much the same.
Yeah.
The All Ords and the ASX 200 look similar. I've been playing around with this. Probably don't worry too much about those lines. It's just something I've played around with. I haven't looked at this for a while. I think I drew this on a while ago, but people are probably wondering what lines I've drawn. I was just playing around with a longer term trend channel. It's interesting when you look at this. It's only got a couple of touch points on the bottom. Look, maybe it's got three. You could almost say, look, that's a third touch point. That big overshoot during COVID. So this goes back to 2009. So it's really long term. At the top, you got like an upper boundary's been reached a couple of times. That's where the market is now as well, which is interesting. So maybe it could be a cause for the market to pause around current levels, but I don't talk about this too much because it's just so long term. It's hard to come on weekly and talk about things which go back to 2009, and I'm not super excited about this trend channel. It's just something I go through charts and I look for things. Some things I want to talk about because I think, look, we can build a story around that now. Other things, probably more for my interest, really. I'm just drawing something on the chart. I'll look back at it from time to time and go, oh, yeah, that's done this or done that. But the All Ordinaries, it looks very much like the ASX 200. The ASX 200 is the driver of the bus.
All right, fantastic. Well, it's funny that you mentioned about the lines, the trend lines as well, because when I first started in technical analysis world, they were a big part of my analysis. But now listening to you a lot, it just makes a lot of sense just to use them as more of a, I don't know, a bit of a backup to what you're really, learning the story around price action and letting that guide your thoughts versus just trend lines, right? So, but yeah, it's good that you talk about that, I think, and the difference in knowing when to use them and when not to use them.
Because there's always discretion around where you draw a trend line. There's often discretion around it, and what one person thinks is a line, another person doesn't. But the 100-day moving average is what it is. It's a calculation. So there's sort of no interpretation about where the 100-day moving average is. And it's is the moving average rising? Is it falling? Is the price above it? Is it below it? We can actually answer these yes or no. Doesn't mean that we're going to know where the market's going to be next week or next month. But I think if you follow good process over time, well, then things tend to have a better chance of going your way over time.
Yeah. All right, fantastic. Let's get on to the US markets then. Obviously, they've had a bit of a pop.
Yeah, so how quickly sentiment changes. So last week, there was concerns, there was nervousness, and we had this quick 3% fall, and market just came away pretty much overnight back to the 50-day moving average, like falling from the October high, and then here we are this week, and the S&P 500 is at a new all-time high, and this is something interesting. So on Wednesday, so we've got the so we had Wednesday's election, and then the next day, the S&P put on 2.5%. So that was the largest post-election day rally. So one day. So we're talking about the one day following the election. That was the largest one-day rally after the election in the S&P 500's history. So that all happened last week, up 2.5% in the day. The Dow, the Nasdaq, similar rallies for those. So all those big cap indices in the US, they're at all-time highs. So should we expect the market to do what it did last time Trump won? And this is what people are doing now, I think. They're saying, oh, look, this is very bullish for the market. Trump's bullish for the market because it worked well last time. And what was so interesting last time around was people thought a Trump election was going to crash the market. We'll have a look at that in a moment. But let's just quickly go back to 2016. So that's when the last election was. So let's just go back to 2016 and just see what we had. Back we go. And so 2016 this is election day in here, early November 2016, and it's so you actually can't see the sell-off on this chart because this is the S&P 500, the index, which only trades during the day. I'm actually going to go to a futures chart. Let me just quickly jump over to a futures chart because the futures trade almost 24 hours. So they were trading when the results were coming in for Trump, and have a look at the difference. So this is election day here, and so when the results started going Trump's way, the market sold off. It started to, wouldn't call it a crash, but it was a pretty significant decline during the what was the night session for the US, and then the day session opened and the market did what it did. It stabilized and then just didn't look back. So that's something you don't see on the S&P 500 day chart. You need a futures chart to see that sell-off. So very different sentiment to what we have this time around. So just going back to our regular S&P chart, so you can see that large intraday move disappears. Couple of differences. There are similarities and differences in the charts. So the similarity being that the market had been fairly recently through maybe a 12-month large pullback, large correction in the market. But then the big difference, and that's like what we had a couple of years back, Big difference is, so when Trump last came in, so just looking at this low point from January 2016 to election day, market was up about under 20%. It was less than 20% off its lows. And then you look where we are now. So coming back to present day, here's the big correction in the lead up to the election. Although this is a couple of years ago, the correction was more recent in the last period. But the big difference here is the market isn't 20% off its lows. On election day, it was about 65 to 70% off the lows. So it's quite a different setup now than it was then. For me, though, it's all about the market structure, not so much who the president is. It comes back to like those moving averages, things we just spoke about, the ASX 200, 50-day, 100-day moving averages are rising, prices are above the moving averages. So for me, I think the odds favour the uptrend. It favours staying with that trend, and that's been the play all year. There's been plenty of there've been periods of uncertainty and nervousness throughout this year, but the play which has worked best has been staying with that trend rather than trying to do something else, trying to get out, trying to look for tops. Will this continue to run for several years like it did in 2016? Well, nobody knows that, but I think we look at that underlying structure and we go with that. At the moment, it's going with the bullish trend. I think if you're looking for tops and you're looking for reasons to be out of the market, if you've been doing that over the course of this year, well, it's put you on the sidelines during what's been a strong year. I think the play here continues to be long stocks, be actively looking for opportunities. As always, though, wide trailing stops to see off those inevitable pullbacks, which we get, and also get me out when conditions change. Because at some point, the conditions will change. At some point, there will be another 10%, 20% or more pullback, correction, and bear market. These things do lie in the future. We just don't know when. So I'm not trying to pick tops. I'm not trying to second guess when the market peaks. Go with the flow until we see signs that it turns. And for me, that will be the market being below the moving averages and the moving averages rolling over. So it's not bullish forever. It's bullish while we have a structure which supports the probability of higher prices.
Yeah. So it's obviously it's one of those things where it's hard to, as you say, pick that top. I think this is sort of going to lead into one of our general questions that's going to come up. Well, we're still looking for opportunities at the moment because we just don't see this reason to get out, but just be prepared, right? Let's look at the Hong Kong markets. Nothing really changed there.
And also just one more thing, it's just don't be complacent. Just don't think, oh, Trump's in, that means market's going to surge. Market's just going to be, we've got 4 years of bull market. I think that would be a very dangerous mindset to run with. Don't be complacent. Don't be overconfident. Yes, there's an upward trend in place. I'm long stocks. I'm staying long stocks. I'm actively looking for opportunities, but it's not buying anything. It's not leverage up and just shut your eyes. The market's going to rise. Always need to manage risk and don't want to be complacent, want to look at things. Stocks have to have the right setups. Got to think about the risk versus the potential reward. There's a whole lot of things we need to consider in building a portfolio.
And that's the beauty of our show. We always look at the both views, whereas a lot of I think people, beginners and all that, as you say, will shut their eyes and expect the market to rise based on a lot of the fundamental news that's out there around Trump being so pro-business and make it rise, right? But us having that the ability to have countermeasures around that is fantastic. All right, so let's have a look at the Hong Kong market then.
Over to Hong Kong, not really that much change from last week. So a little bit of movement, but not a whole lot. It still looks like the Hang Seng's going through a basing phase following that powerful rally we saw during October. Volatility's dropped back. Prices seem to be now stabilising above these moving averages. Again, the 50 and the 100-day averages. I think that is positive that the Hang Seng is holding on to much of that recent rally. So that rally through September, that was a big rally, and I guess the risk is when you see a sharp rally, if the reasons behind it don't start to hold together, some of these rallies can quickly unwind and come all the way back. I like that this is now, it had its initial pullback, but I like that it's now finding support. So there seems to be buying interest, seems to be interested in buying this dip. I still think this might take a bit more time, but at this stage, it's developing in the right way. It's now consolidating just above the moving averages. When we go over and have a look at the Chinese market, very much the same goes here. Prices had a strong up day last week, last Thursday. They looked like maybe they were going to try and push a bit higher. Then they've come back just as quickly, but now they've stabilised again. So there seems to be that stability around the moving averages, which is a constructive thing to see. Again, it looks like there's that interest in buying the dips. I think this remains a developing situation. Probably, as I said, with Hong Kong, with the Hang Seng, probably needs more time. But I'm looking at this with optimistic interest. I don't think it's quite ready. Like, there is a case for establishing a position around current levels and just having a stop loss below the moving averages. I think there's a very viable case for doing that. But as I say, it might take some more time. There could be some more backing and filling. So for me, I'm probably just watching it at this point. But it's one which is continuing to look of interest, and I think we want to be looking at it for upside potential.
All right, fantastic. Thank you for analysing those three major markets for us. Let's get on to some of the viewer questions now in general. We'll start off with Michael's. Michael sent in a question around, obviously, we did a pre-recorded show around stop losses last week. In the systems that we talk about, use these active stop losses to ensure we protect capital. But he's got a question around what's your thoughts around, I'll read out the question because it's quite long-winded, but in that sense, so you can answer it. If you run into a stretch of a few days sessions where you get stopped out for your positions for a few of your holdings, Jason, Michael was a bit annoyed when it happened because it increases my cash position, but at the same time, I thought it could also mean a trend change in the market as a whole, or something is not quite right. Should I back off and observe further? I have a tendency to keep searching for other new replacement positions to rebalance my cash positions. How would you answer that?
Yeah, it's an interesting question. So we shouldn't be annoyed when our cash balance goes up, I think, because that's sort of like one of the risk management strategies, in that when a stop loss goes off, it goes off to protect capital, and then that capital goes to cash. So if you're accumulating cash, it is part of a defensive strategy. So it's not just about being invested all the time. It's about being invested when the conditions validate being so. So just having your cash balance go up, that's I don't think that's a bad thing. Now there'll be stop losses that can go off within a bullish environment. Stocks can be generally rising, and stocks will at time to time hit their trailing stops. That will go to cash, and there will be another opportunity the next day. That money can then be quickly rotated into a new idea. There'll be other times where, as Michael was explaining, there could be a flurry of stop losses go off in a short space of time, and then when that happens to me, it'll be like, well, I'll look at why that is. I'll question, why has this just happened? Why have all these stops gone off? Is it just to do with that particular? Is it just coincidental within the company specific things? More often than not, though, you'll find that it's market orientated. For some reason, the markets come back or a sector's come back. I'll look at the market structure. We've already done that for today. The market to me looks like maybe it wants to consolidate for a bit. If the market looks like maybe it wants to consolidate, I may take my time in putting that capital back into the market. I mightn't want to just rush back and say, look, quickly, I want to just get it back in. I want to get it back in. It might be, well, there are stops going off. Maybe that's a sign that there's more consolidation to come. So maybe I don't need to be in a hurry to get it back in. So my defensive strategy of having the cash pile build, it then stabilizes my capital position in case more stocks come and hit their stop losses. But generally, I will be looking for the opportunities. If I see a good opportunity, I'll get it straight back into the market. But it's not a case of I've just got to get it back into the market. It's like I want to wait for the right opportunities and get it in when the timing seems right. Nothing. I think it's good to be patient with our buying. Wait for the right setups, not just I've got to replace a stock which has gone out. Particularly when there's a number of stocks doing the same thing. It could be giving you that. It could be an indicator that the overall market might want to consolidate, in which case maybe you've got a bit more time to move that money back in.
All right, fantastic. Thanks for that, Michael. If there's any other questions off the back of that, I can see you're online. Just feel free to chime in, and we'll try and get to that. Next question's from George. You use the 60-day rule to sell stocks that don't perform, right? His question is that my question is, if he buys a stock and says the stop loss, if he buys a stock and say the stop loss is 25% and the stock drops really quickly in, say, 1 week by, say, 20% and potentially stays there, will you cut it before the 60 days is up? Do you want me to repeat?
Yeah, no, I've got that. So this refers to my time stop for those who aren't aware what the basis of all this is about. So if I buy into a stock and it's broken higher, it's given a buy signal, and but then it stalls and it starts to drift back and it doesn't do much after 60 trading days, or about 3 months. If it's not in profit, I'll move it on. I'll just sell it, even though it might still be above its stop loss. I'll just sell it, move that capital into a new idea. So in this situation, and I'll get up a stock. This comes to mind because I was talking about it in my weekly Motion Trader report a couple of weeks ago. It's a local stock called Catapult Group. So this was a Motion Trader buy signal in July 23. So we've gone. It had a lengthy period of underperformance. Stock's trending lower. Don't want to know about it. Gets back above the moving averages. Moving averages cross, start turning higher. There's not an initial signal here because I've got stock also needs to be at a 70-day high. By the time the moving averages crossed, the stock wasn't at a 70-day high. It started to pull back, so there's no signal. Then it starts to rally off the moving averages, triggers a signal. So there's the Motion Trader buy, rallies for a couple more days, and then starts to sell off. And this actually came back 20%. So there was a 25% stop loss. So I've got a stop loss somewhere around, wasn't too far from the lows. So it actually came back about 20 or so %, just missed the stop loss, and then started to rally, didn't look back. So few comments on this. So for me, I would have exited the stock on my time exit. So I would have been in loss after about 3 months, and I would have sold it. I would have moved the capital to something else, and that would have been the end of it for me. If I'd just used the stop loss as my exit mechanism, not a time stop, I would have been able to see off that pullback, and it would have re-engaged within the uptrend. The reason I use wide stops is because it's a less active approach. If you want to use tight initial stops, there's going to be a whole lot more activity because stocks will they'll run, they'll pull back, they'll stop out. There's a lot more activity. That may be okay for some people, but if you don't want that that degree of activity, the wide stops can be helpful. The specifics of the question was, what if a stock quickly comes back? So say you buy it and then it quickly falls back towards the stop loss, doesn't quite hit it, but gets close. Do you persist with it for another few months, see whether it comes good, or do you just rule it off then and there? I'd be I'm rules based, so the rule is it's 60 days or the stop loss. So I'd more than likely just continue holding it, unless I really needed to free up the capital for something else, but that rarely happens. So I'd be inclined, even if it comes back sharply initially, if it's above the stop loss and within 60 days, I'd probably continue holding it.
Yeah. All right. I think that once again, the key word there is rules based, and try and sticking to the rules, because if you have too many variations of the rules, once again, you can get really confused.
And you can, if you follow the rules, if you're sometimes following the rules, sometimes making new rules, and you're doing that quite a bit, you kind of end up not having a system. You've got components of a system, so then that's going to lead to inconsistency in your trading, and I think that all can become quite messy. Almost all of us are going to stray from our rules from time to time, but if we have awareness of when we're doing that, and we have the discipline to get ourselves back on track, I think that's when we're going to have the better results over time than if we're trying to, in this situation and that situation, you're doing different things at all. You really pull apart what can work well for you, your system. Don't pull your system apart. Try and follow your system as close as you can, and not get too focused on the individual outcomes. It's not the individual outcomes that make the big difference over time. I think it's being able to follow a good system over time, and if you follow a good system over time, the overall outcomes have every chance of going your way, even though sometimes you get dealt a bad card. That's okay. You take a loss, move on, keep following that good process over and over again over time, and that's when I think you put the odds in your favour.
Yeah, exactly. I mean, and if a stock really goes against you 20% straight away, you've got that rule saying, all right, I'm going to wait 60 days. If it doesn't hit my stop loss beforehand, I'm just going to stay consistent with that, because at the end of the day, even if you don't know what it's going to do in 30 days or in 40, you never know. It might bounce. So if you cut it beforehand and you've got no rule around that, and you're going to be kicking yourself, right? So I think the key is just sticking to either one, the stop loss or the 60-day rule, right? So in our system, obviously, if you're using this, right? So all right. The other question is around like entry points. Now this is kind of the opposite. So I think, just in the interest of time, if we find a good one, we might, from all the viewer stocks to analyze, we might just point it out, right? So the question goes, show us some examples of where you would actually buy. I understand. It's not just on a 50 to 100-day crossover, right? Is there something else? Would you be able to classify them in like an A class, a B class, or a C class stock entry point? Jace, do you want to give us an example of something that's an A class entry point, or do you want us to go through the?
Well, I don't want to. So firstly, A, B, or C. If it's a B or a C grade setup, I'm probably not too interested. I want to really focus on what I think is an A grade setup.
Mm-hmm.
I want a stock that meets the criteria. So just looking at this one on the screen, just looking at this, I talk about this sort of setup all the time, where you go from below the moving averages to above. You get the sideways consolidation into the moving averages. So this is an A grade setup. We've got rising moving averages, prices pull back too. So there's two plays here. One is buy the dip, and possibly using a relatively short stop loss. Might only be like a 5 to 10% stop loss. The other alternative, which is probably the one I use most, is the breakout. So you can see the top of this range here. So the price breaks out to new highs. That's an A grade setup as well. So I'd want to buy that sort of setup. So we have the rally, the consolidation, the breakout. Now, this is why you've got to give stocks a bit of room to move, because this is broken out, it's run, then it's pulled back to the moving averages again. If you got your stop too close, you're going to get stopped out there. And that may be okay, because maybe you're going to like try and get back in again. Sometimes some of my best positions are ones that run from the onset. But nonetheless, I'd tend to, like with a stock like this, I'd probably have a stop loss at least below the 50-day moving average. So maybe I could, a tighter stop could have seen off this pullback, and then the stock gains its momentum, it runs. Again, here's another breakout point here, rallying off the moving averages. That's a breakout point, and this is also a buyable dip back to the moving averages, and so on. I'll show you a stock which I spoke about in my weekly strategy session on Friday. It comes to mind. What was the code? I think it was PRN. So I do these strategy sessions every Friday, and I'll often talk about a couple of stocks at the end which have come up in the motion trader signals, which I like the underlying structure. So this is a stock in the mining services industry, Parenti or something along those lines. Bit of history. It's been struggling for a while. It's been below these moving averages for a number of years. It's come from great heights back in 2018. But is it a turnaround situation? Possibly. So what I like about this is I like that it's gone from below the averages to above the averages across. We generally have rising moving averages. We have a series of rising lows. The highs are getting higher as well, and we've got this acceleration just in the last couple of months. You can see we're just really moving sideways along the moving averages. Then we get a break to a new high, pull back to the averages. Then we get an acceleration. So this was a buyable break just in October, and I also like how it's pulling back now. So it's setting up for another potential entry point, and this is what I was talking about in the strategy sessions. I like that we've had this strong rally off the moving averages. This pullback, it's not giving back too much of that gain. So it looks like there's interest in buying this dip. So a couple of ways this could be played. Do you buy the moving averages are catching? Could be a case where this tracks sideways for several more weeks into the moving averages. So maybe the dip could be bought around $1.14, $1.15 stop loss below the 50-day moving average. So it's about a 10% below perhaps. So relatively low risk considering the potential upside. Or the alternate might be to watch, see if it continues consolidating, see if it then breaks out. Then if we got something like price action like this, some more sideways, and then from there we get a breakout, then that could be the buy point. Then a stop loss again back below the 50-day moving average. Maybe it's around 10-15%. And then you're on a stock which has upside potential. Could this stock double? Yes, it could double. It's certainly, that would be still well below its previous high. So it's one of those stocks which could run 100%, and you can potentially get on with 10 to 15% of risk. So I think that's asymmetric. It's a type of setup I like. Impulsive rally, chop sideways, moving averages catching up. That's what I like to look for. I might also look at 10 and 20-day moving averages. I'm trying to catch something earlier in an emerging trend. But for the most part, I'm getting my signals based on the 50 and the 100 days. That draws my attentions to stocks which are potentially setting up opportunities. And from there, that's where my best trades come from. The ones which are up 100, 200, 300. I think I might have a stock which is up 400%. And they all start off at relatively low levels with rising moving averages and prices breaking out.
All right, fantastic. I hope that answered your question, George. And I mean, the good point about it is there, I think, as well. You've cut out options B and C, and you're just going for the most quality ones, and that is A-grade ones, A-class ones. I always go back to this philosophy of sometimes less is more. The less options you have, sometimes the better it's going to be, right? So less confusing as well, right?
Like
So,
we don't always need to be doing something. Like activity for the sake of activity and chasing marginal trades is a great way to chew up capital. So if there's nothing to do, don't do anything. You'd be happy to sit there and do nothing for a month or 2 months. If we're in a bear market, maybe not doing much for 6 months. It's like if you don't have a good shot, don't take it. That's okay. Part of the game is knowing when not to play the game, and that's a really important part. The urge to do something. I think this is one of the great advantages of the retail trader and investor. They don't have to play. Like when I was back in the bank's dealing room, there was an expectation that you were going to make something happen. But much of the time, like you go a few days, not do much, but you really couldn't go a couple of months without taking a trade. You'd find you didn't have a job pretty soon. So you had to try and make something happen, and that encouraged us to take trades which were probably bordering on marginal. But we don't have to do that. As retail, we don't need to do that. If the setup's not there, that's fine. Walk away, do something else, wait for the setups to be there, then play, and build a strong stock portfolio based around stocks with really, really good setups. And if you've got to wait a while to get those setups, well, so be it. When the market's in the right conditions and stocks are trending, you'll tend to get the right setups appearing. And you just got to be patient, got to wait for them.
all right, let's see if we can find some A-grade setups amongst the viewer tickers here. Let's start with IPX, please.
Yeah, nice new surge higher, and this has had several of those setups too. We've looked at this before. You can see I've already got like one marked in. The rally, the sideways movement into the moving average. Do you buy the dip on the moving average? Just one possibility with the stop below it, or do you buy the breakout? And then we've got another. And sometimes it's messy too. Like look at this one here. It looked like it was breaking high and then pull back to the averages again. So we're going to get a strategy can be clear cut, but the execution isn't always clean. It could have easily have bought that breakout and then been stopped out, and it's gone sideways for a bit longer. But then we do get another breakout, and this time it runs, it breaks, consolidates above the breakout, and runs again. So it's as I said earlier, it's about don't worry so much about the individual outcomes. If it's a good process, be confident to continue following it time and time again over many situations, and let it work over time. Not worry about individual outcomes where it doesn't always play out. As it stands now, I think that's probably that's an all-time high. If I was long this stock, I'd continue to stay with it. There's no cause here to sell. I'm not into picking tops because we never know where the ultimate top's going to be. I'd struggle to buy it now though. I don't. It's pulled away from the 50-day moving average. It's like risk reward. It's not asymmetric for me. It could continue trending higher for many more months, but for me, this would be more like I'd probably see this more like a B grade entry point, or maybe a B minus entry point. I don't really want to play the B minus. I'll probably prefer to wait for an A entry point where, like we had in late August or like we had in late January. They're my A entry points. This is my B minus entry point. Trending higher, it's above rising moving averages, but just my risk is higher. It's like I've got to have a wider trailing stop to get back below the 50-day moving average. And it's getting stretched above the averages too, which then increases the odds that it's going to get some consolidation. So, but definitely for me, it'd definitely be a hold if I had it.
All right, WBT.
Did I get that right? WDT?
B for Barry.
B, Big Bad Barry. Mm-hmm. Okay. This is all taken off. It's been a volatile stock, this one. Boom bust stock. So yeah, there's the big boom during 22 into 23, then the big bust. It's like I'm not on this. It's not a motion trader stock. You can see the moving averages haven't turned yet. This sometimes happens where a stock, it just takes off before the averages have time to turn. So I think we need to accept we're going to miss stocks. Always going to miss stocks. There are going to be ones that just turn and run too fast. I said earlier that sometimes I look at 10 and 20-day moving averages. If we were looking at, be interesting, let's just have a look. The 10 and 20-day combination. And so if you're looking at this on a 10 and 20-day combination, you can see that it goes from below to above, the averages cross, consolidates along the moving averages. So it was looking interesting. It had this sell-off below, which would have probably thrown things again. Like if you're going for a short-term entry, I probably would have had a stop, which would have been triggered. Then it turns and rallies again. There was probably enough time to buy this breakout around the 220-ish mark. But you're going to be following so many stocks if you're trying to do this on a 10 and 20-day basis. It's for me, unless you're specifically following this stock or had reason to look at it, it was a very difficult move to catch. If someone did happen to catch it, though, I'd be happy to stay with it. I'm not ready to buy it at this point for the reasons we spoke about with the that last stock. But if I managed to get on early, I'd stay on, see whether it consolidates while the moving averages cross, and see whether the rally extends. But for now, for me, it's not a buy. But it's if you got it, I'd be holding it.
All right, fantastic. Let's have a look at VUL.
Was that VUL? It was, wasn't it?
VUL, yeah.
Yeah, I think it's a nice evolving setup. The stock looks to be rallying off the moving averages again just in the last few days. It's probably one of those ones. Like, I'm just wondering, does it like we could see this stock come back and just continue to move sideways for several weeks and then rally, or it could rally here. We don't know. We won't know until we look back in hindsight. It's got the potential to rally now. But with what I've said about the broader market, maybe there's more chance that it does sort of like come back and we get more sideways consolidation. If I was in this stock, I'd be happy holding it. I'd have my stop loss below the 100-day moving average, see whether this trend really does continue to develop. If I didn't have it and I was interested in it, I'd probably just watch it for now, with it just sitting below the high from October. That's going to be a resistance point, and we have the market pulling back a bit. So maybe it's going to stall below this resistance and pull back. But if it were to break above it, well, maybe then it's a case of going with the breakout. But at the moment, I think I'd bide my time with this one and see whether we get more of that consolidation. And then it's a case of, do you buy the dip back to the moving averages, or then you might have like a more constructed range to play with, which you're buying the break from the range. But yeah, a good one to keep watching.
All right, SXG.
Well, this is held in really well, considering what's going on in the gold sector generally, with gold pulling back. It's just come back to the 50-day moving average, and it's holding firm. It's which is a really, really encouraging sign when a stock does that, when it holds up despite volatility elsewhere in its sector or in its underlying product, which in this case is gold. It's good. It shows there's not a whole lot of panicky money in there, or there's really good underlying demand to soak up any stock coming onto the market. If I had this, I'd continue holding it. I'm probably not in a hurry to buy anything gold at the moment, because it looks like gold's now having that consolidation, which all these markets are going to have. Markets that run, they've got to pause, they've got to consolidate. Gold's had a fairly uninterrupted run over the last few months. It's normal for it to pause and consolidate, which it's currently doing. So I'd be
We
inclined.
okay to look at that gold chart? We okay to have a look at that gold chart after this one?
Yeah, I've got it here. Again, this is sort of stuff I talk about in my weekly strategy sessions. So if people want to hear more of this sort of stuff, come over and check out the strategy sessions on Friday. Do them live, or you can watch the replay. And this is something I've been following for months. Pull back to the 50-day moving average. It's normal price action. But it's people who join in late, who just see gold rising and go, oh, well, it's just going to keep going up. It's it doesn't work like that. You're going to have these shakeouts, take out the latecomers, worry some people who have been there for a little while. They worry, oh, look, I don't want to give back my profits. But at this stage, I'd be viewing this like other pullbacks to the 50-day moving average. I think the underlying trend remains in place. But just looking at the size of that move, that's a decent move in the last couple of weeks. It's come back $150 or so, maybe a touch more. You look at SXG. Well, look, it initially did have that sharper pullback. But just looking at gold last night or gold yesterday had that sharp decline. And you look at SXG, it hasn't had that sharp decline. So it's finding support. It's being underpinned. So I'd be very happy holding this one if I was in it. But as I say, I would be rushing into gold stocks just yet, because this could take some time. Like you look at like that was a multi-month consolidation. This is a shorter one, but still took about a month to play through. So there's probably enough technical damage done in the near term to suggest that, it wouldn't be surprising to see some back and forth in the gold price, and that will probably be reflected in the gold stocks.
All right, let's have a look at FFM then, please.
Sorry, what was that code, Rog?
FFM. FFM.
Yep, got that. I'd be happy holding it still if I was in back down here at good levels when it first started breaking higher, or even some of these other breakout points. I'm still happy holding it, but it's probably going to take some time. I think there's a larger consolidation now in play. So it went, we had that acceleration higher last month, and now it's come down at almost the same speed that it went up. So that's a sign that it needs consolidation. It needs time to sort of move sideways. Let these moving averages catch up, probably get a bit messy, and then from there we can look at maybe can the trend continue to extend higher. So I'd be happy holding it. I'd be working on the basis that the incumbent trend is up, but I'm probably not in a hurry to buy it just at the moment with that little bit of the ASX 200 looking like maybe it's going to consolidate, sharp decline. I think it's also gold related as well. So the same comments with SXG.
All right. Let's look at HGO.
Let's just see where it's come from. So it had that's a while ago now. It's really hasn't been doing much for the last few years. It's just been within this big range. It's not a stock I'm in a hurry to really do anything with. It's we still don't have positive moving averages, and the price is starting to back off again, and it's just in this large sideways range. We don't have an underlying trend. We just got it's just swinging back and forth from its these highs around 10 cents and the lows down around 4. I'd prefer to leave this one alone.
All right. We're looking now at NML.
Is this the right one? NML?
NML.
It's declining moving averages. Prices below the moving averages. It's also like a 2 cent stock. It's just such a speculative play. You're kind of buying it, hoping it's going to do something. So there's probably an underlying story which somebody likes, but the the price action is telling us that the market isn't attached to that story, and it keeps getting distributed every time it rallies. All these rallies back to the moving averages, there's just supply coming on. It keeps pushing it lower. So unfortunately, I've got to say this is just one to avoid.
Yeah, I'm assuming NMLDA is an option or something on it. I should have a look at that one.
Yeah, it'd be related to the stock.
Just
DA and yeah, it's yeah. So we'll just go off the main stock, and yeah, that's the unfortunate situation. It's a stock in a downtrend.
All right. The next one is AUB.
Yeah, well, trend here remains up, but the trend is stalling. It's a bit like it's not dissimilar to the ASX 200, in that we've got the this is the August high. The ASX has an October high, but we have a high. It's pulled back, hasn't rallied back to the high yet. So it looks like we're in a consolidative phase where it's just we're not really under a dominant near-term trend. The stock really hasn't been trending for the last 3-4 months. But you go back further. Look, there is the overall momentum is to the upside. So if I had this stock, I'd continue holding it. There hasn't been a reason to sell it at this point, but I'm not in a hurry to buy it. And I'd have my trailing stop in place. So if it, like maybe it goes sideways for several months and breaks higher again. A wide trailing stop could see you through several months of sideways price action. If you're in at good levels, no point selling a stock which you're in at good levels just because it's going sideways for a while. Triggers a tax event. It stops the inflow of dividends. I'm happy to sit with a stock going sideways for months if I'm in at those good levels, and just see what happens, see if it does re-engage with that upward trend. So for me, this would be a hold, but not a buy at the moment.
All right. RUL, maybe a cup and handle developing.
I like the so it's come a long way, this stock. I've actually got this stock myself. I like the rally, then the sideways consolidation back towards the averages. We talk about that pattern all the time. So it's got that nice rally and sideways. The cup and handle, I think that our viewer is talking about would be this, I would say. So there's the it's a pretty deep cup, but so we can see the price action. You can see how it does sort of like the price action does swing around, and then you've got the then this here would be the handle. So you've had the sell off, the distribution, and then they got the buying of that dip, which pushes it back up. Then you got the sideways consolidation forms the handle. So we're now looking for the breakout, or the the buying of the dip back to the moving averages. So that's the cup and handle pattern. Funny names, but they do help us visualize some of these chart structures which lead to higher prices. So I'm happy holding this one. I've got my wide trailing stop. The breakout could be bought, or maybe it could be bought if there's another dip back to the 50-day moving average, stop loss below the 100-day moving average. So yeah, it remains a stock which continues to be in an upward trend.
All right, let's get on to a few from Talwyn here. MAD.
Well, it's gone from below to above the averages. That's an encouraging sign. So this is involved with mining services. It was a great trend. It had a great trend in this stock during 21, 22, and 23. And following big advances, we often get big consolidations, and that's what's been playing out in this stock. My thinking here would be it's gone from above to below. Often when we go from below the moving averages to above, we often get a pause to consolidate while the moving averages cross and catch up. So on that basis, I probably wouldn't be a buyer at current levels. I'd be waiting for the next consolidation, see what that looks like, see if we do get some sort of chop sideways to lower, back towards the averages, and then I'm looking at it. So I think this is it's potentially developing into an emerging trend, but I'm not in a rush to dive in at the moment. If I happen to have bought it earlier in this rally, well, fine, I'm happy to hold it, but I'd look for the next consolidation and then judge how that looks. Look for some setup points around that. But maybe this is coming back into play.
And EU.
Yeah, again, one of those ones which is really hard to catch. It was like we looked at this last week, I would have just said, look, no, it's moving averages are trending lower, prices below the averages. I just want to leave this one alone. And then you come in the next day and the next day and it's up, and then it's up again, then it's up again. And it's like, well, I'm not going to catch that. I'd still be leaving this one alone. Not dissimilar to MAD in that I want to see what the next consolidation looks like. So if this now tracks sideways for several weeks and these averages start to turn, you start getting a structure that you can play with, going, okay, well, look, I can see I can manage risk around it. Maybe we get, you see something like that form. Moving averages start to cross, and then you say, look, okay, I can buy it here. I can have a stop loss just below the structure, or I can buy the breakout to a new high, and then that's how. And again, you can manage risk around that too. So that's the way I'd be looking to play this one. I'd be watching it for now, see what develops, and if it just gaps higher tomorrow, and some of them I'm going to miss, so be it. But I'm not ready to, I don't have the parameters to really play this one yet. And I think the odds favour we'll get some consolidation before it does anything else. But for now I'm watching.
Okay. A bit of talk around this one, which is LYL. LYL got stopped out on LY recently on a weak daily candle. How to avoid? It's actually good to see the viewers engaging in some commentary, and I think we're going to use some of the commentary here for maybe a topic we can talk about next week, looking further into volume and how that's used on the charts, right? So, but what's your thoughts around this one, Jace?
Look, I had this stock too, and I cut it, hit my trailing stop, so I was out. And it'd been a lovely trend. I'd been in it for some time. I can't remember where I got in, but it'd been a motion trader stock for quite a while as well. Probably saw off that pullback with a wide trailing stop. So it's probably been a motion trader stock since somewhere in 22. Hit a stop. That's going to happen. They're going to be stocks that come back, trigger a stop loss, and then rally. It happens because a trailing stop, it doesn't pinpoint the level which leads to a collapse in the share price. It's just a calculated level based on data where we say, okay, we've given it enough room. We've got to now put in place actions to protect capital. And that's all it is. It's not saying the stock has to continue lower, but it's continued low enough that now we've got to like rule off. It's a line in the sand. We've say enough is enough. And it's not the ones that bounce back that cause you trouble. It's the ones that you don't sell and then continue to unravel. They're the ones that ruin portfolios and are lead weight in portfolios for sometimes years into the future. So that's what we're trying to avoid. And the everything's got a cost benefit. The cost of a trailing stop strategy is you're going to get some stocks that rebound. And the benefit of the trailing stop strategy is you're going to most likely avoid the ones that just continue lower for 50, 60, 70, 100%. so get you out. But there's a cost. The cost is that some will trigger at the near or at the lows and rebound. Now, at the moment with this stock, it is still in a vulnerable position. The moving averages are still declining and it is still consolidating below the averages. So I wouldn't say this one's out of the woods as yet. It would not at all be surprising to see price action like that develop from here. I'm not saying that's going to happen, but it's well within the realms of possibility. I'm comfortable being out of this stock. I'm not looking at every day going, oh, it's annoying. I should have held on. It's like, well, I've moved on to other things and having some extra cash in my account as well, with a bit of uncertainty, also not a bad thing. So for now, I'd just leave this one alone. If it gets back above the moving averages, starts to consolidate, the averages start turning back up, well, I can have another look at it. But at the moment, there is still some vulnerability. So I'm not rushing to want to jump back in.
All right. Let's have a look at REH. Went below its ATR stop level, but has since rebounded. Could you comment?
Same as the previous stock. It's still got the moving averages. They've rolled over. Prices below the averages. It could consolidate sideways and then take another dive lower, or maybe that's slow and it starts to recover. But as I said, it's not the ones that recover that cause the problem. It's the ones that continue lower. So, what do? You say, okay, it's hit my trailing stop, but I really like it. I think it's going to come good. So you hold it. Now it breaks to a new low. Now what are we going to say? Well, I still really like it. And I've let my stop slide here. So really, I probably should give it a little bit longer. Now it's down 20. Now what are we going to do? Well, I think it's going to bounce and I'll get back out at 22. But it doesn't bounce, it goes to 18. Now what are we going to do? And you can see how this thing just snowballs and gets out of control. That's what we're trying to avoid. It's going to be ones that rebound and go off and hit new highs. They're not the ones that cause you the problem. The ones that cause you the problem are the ones that are quickly down here and you haven't sold because you didn't want to. They cause more trouble to your portfolio, because you can always get back into these stocks at higher levels if the structure starts to change and we've got a stock which is then back above moving averages. We can, like back down here, okay, I would have said, look, this stock is in a, I would have said this is a vulnerable position. It's triggered, let's say it's triggered as trailing stop, vulnerable position below the moving averages. Look, it's turned around back above the moving averages. We can look at it again. Let's see what it looks like on the next consolidation. Pulls back the averages, starts to rally, breaks to a new high. Okay, look, momentum's coming back to the upside. I guess there's a case for getting back in, put a stop loss back below the 100-day moving average, see what happens, and off it goes again. You get back in. But if you stay in and it's down at $17, $15 and below, you can't get back out where you probably should have got out at the first place. So that's why I'd look at stocks like Reese and like LYL.
All right, RSG.
Yes, well, this was in the headlines last night. Mining stock in an African country with political instability, and this sort of thing can happen. It's and it does happen. It's there was one stock. There was a lithium. It's a lithium stock which has now been delisted. It went from all-time highs to sold off and then got suspended. I've forgotten its name, and then delisted. So shareholders lost 100%. So there's always a risk when you're in these countries with less stable systems of government. What to do now? If I had this in my portfolio, I'd exit it, because I don't know. I don't know what's going to happen. And of course, no one knows what's going to happen. Everything could be good, and the shares are quickly back. Quickly put on 20 cents. But I don't think they're quickly going back to their highs. A lot of technical damage has been done, and a lot of fear will now be around the stock in general. I'd cut and I'd move on and just take something which is just going to be a frustration sitting in my portfolio, which I'm looking at every day going, is it going to come back? Am I going to get a better exit level? I'd rather just go, this one's just it's just an unfortunate situation. I just got to cut it. I just got to move it to the side. And if it's a relatively small position within a larger portfolio, which is one of the strategies which I always talk about, many relatively small trades, it may still be a meaningful dollar value, but it's relatively small compared to an overall portfolio. It's like, maybe it's 2% of a portfolio, or 1% of a portfolio, or even 5% of a portfolio. It's like, it's still relatively small to the overall portfolio. This is where people get into problems, where they've got a 4-stock portfolio and this is a quarter of their portfolio. Then it's a big deal, a really big deal. Or it's half of a portfolio. It's calamity then. But if it's one part of a wider portfolio, I'm just cutting my loss on this and going, lesson learned with some of these less stable jurisdictions. It may not even be a lesson learned. It's like we go into these things aware of the situation, in that, okay, look, I'm aware that this is in a part of the world which is prone to trouble, but I could make 500% on it. I'm happy with that risk. And if you go in with your expectations correctly aligned, well, that's okay. And you accept that this is going to happen sometimes. But for me, as I say, I'd be out.
All right, and we wouldn't go a week without having a look at APX, please, Jason.
This should be our starting stock for each week.
Exactly. Just keep a monitor on that. Just remind people, if you're not in it, then too bad now.
Well, we had our pullback to the moving averages, almost got back to the 50-day, got close, and now it's rallied again. So I guess this was the buy the dip point. If I'm in this, I'm more than happy staying in this. I think that's probably what I've been saying for the last few months, because it's been rising with the moving averages increasing as well. Look, trend. This stock remains up. It's the pullbacks, it's the consolidations which I think provide the entry points. This was a quick shoot higher, so it's only just broken above the previous high now. So do you buy it at current levels? It's like, let's just do some measurements. This is a problem with volatile stocks. To have your stop back below the 50-day moving average, you're looking at 35%. I'm just not keen on that. I think this was one where you kind of needed to get the dip and then have the relatively close stop below the 50-day moving average. And that was going into the election day, so that was probably going to be a pretty uncertain sort of play for a lot of people. And now it's rallied quickly, makes an entry point now difficult again. So I'm always looking at these stocks like this on the consolidations. But trend remains up.
Okay, we will have a look at two more, and I think we will call it a day. Let's have a look at YAL.
So this is a coal stock, and see, we've got these previous highs. So it's going to get resistance somewhere around, a little bit high there. It's somewhere around there. There's overhead resistance. So I'm probably not rushing to get this at the moment. It's gone from below the averages to above, and the averages have crossed. That's all good. Now we're getting the consolidation. So I'd want to see what the consolidation looks like. Do we get that classic sideways movement along the moving averages, in which case then maybe it's a case of buying the breakout, even though it may still be below the previous highs. Would we buy the dip? That's another possibility. Do you buy this dip back to the moving averages? No, probably not, because I'm looking at this thinking, well, look, this is within a large range. Within a range, there's nothing to say this can't then now pull back towards the lower end of the range. So I'm probably not going to buy that dip. That said, if someone wanted to buy the dip, could probably have a relatively close stop on it. if for some reason you like Yancoal, maybe you could play it with punt it with a 6% stop loss. Go, does it find support at the moving averages? Risk 6%. If it does, and it goes sideways and breaks up, well, great. I got in with relatively low risk, and now I've got all the upside. But if it hits my 6%, well, I had a go. That's the other way to play it. But yeah, I'm not overly excited about it at the moment.
All right. We'll finish off on WBC, please.
Yeah, consolidating following, this is a really, really strong run. The banks in general have had. The whole financial index has moved up strongly recently. Pull back to the average, and now we're consolidating around the averages. So yeah, if I'm in this, very happy holding it. I'd be inclined just to wait at the moment, because it looks like maybe this consolidation continues to play out, maybe continues moving sideways. Buying a breakout, maybe looking at the October high. So a break above the October high, maybe that's the point to buy the breakout. At the point where buying the dip is feasible as well. Where would a stop go if buying the dip? It's probably about 7 or 8% lower, probably below the 100-day moving average. So yeah, that's one strategy, is buying the dip. Is this something like we've seen previously, these previous dips, where it just consolidates for a while and then starts to move higher? It could take more time, but this could be a reasonable entry point. I'd prefer to watch at the moment, just with comments on the ASX 200 at the beginning. But it's within the buying range, either for the dip, or we have a breakout point if we're looking at buying a breakout.
All right, fantastic. I think we will wrap it up for now, Jace. Thanks for all. But once again, apologies for missing some of the tickers at the end there, obviously in the interest of time. If we have time next week, we'll get onto them, or please come back and we'll have a look at them if they're still of interest for you. Some interesting topics of discussion in there. We might chuck some of those questions in there, especially around volume and how we could use volume to better identify some opportunities. And also the age-old question, do you buy on the break or the dip, right? So I think we answered some of that stuff with your A-grade setup question anyway. So if you go to the middle of the show today, if you missed that part, you'll certainly see how Jason, sort of his way of buying, having those A-grade setups. Please feel free to go and visit, as Jason mentioned, his strategy sessions on Friday. Go and check out his stuff at motiontrader.com.au. If you're not a Selfwealth client already, you can check out our platform at selfwealth.com.au and just use the links down below. And you can see all the great stuff we offer there. Like, subscribe, comment. I love seeing these comments. I might not be too responsive of it, but I do love seeing them. I appreciate all the feedback. Keeps us going, gives us the fuel to keep us going. Doesn't it, Jace? So
it does. And I also do individual stock codes in the Friday strategy session. So viewers are welcome to come to the website and find the market outlook and the strategy sessions and see what I'm doing there.
Yeah, and they're fantastic videos as well. You can have a look at Jason on YouTube there as well. All right. Thanks for this week again. And thank you everyone else for coming along. Much appreciated as usual. And we will see you again next week. Ciao for now. Take care, guys.